Number 3, forward inflated market. Why I included this one is I like them a lot. And I think that sometimes, like in 2008, stocks and bonds move in the same direction. A lot of times, stocks and bonds move inversely to each other. That's been the historical relationship, but not all the time. So there's a lot of clients out there that say, hey, Jason, I want to stay invested in stocks. I'm not super excited about bonds, because I think bonds could also go down. It might be a little expensive now. So how can I invest in stocks and have some sort of protection? And they start bringing up options and hedged equities and things like that. So there is a way that you can do that is relatively simple. Myself, I do not feel qualified at all to kind of put together these combinations of things to do that, because you have to really understand futures and options. And quite frankly, I don't even know. I probably know 1,000 financial advisors. I can't think of one of them that I would consider that would do a good job with this. You want like a massive global bank like JP Morgan or Credit Suisse or HSBC or maybe Morgan Stanley, someone like that has a huge team of analysts, that has a lot of scale where people are putting in a lot of money to create these. And what they're basically doing is they're saying, we're going to put together what's called a call and a put. I know that's fancy pants language, and I apologize for that. I'll explain what they mean. When you sell a call, you are selling away some of your upside. So if you have a stock, and it goes up, let's say more than 9%, you don't get those gains anymore. So if the stock goes up 12, someone has bought those last 3 from you. So you get the first 9% in gains, but that's it. That's your cap. You have sold away, and someone else gets the gains above and beyond that. Well, for that, they paid you money. It's called a premium. You can then take that premium and buy something called a put. A put is a thing that protects the downside of your portfolio. So where I think that is super valuable is here is the rate of return over the last 80 years of the stock market every year. So as you can see, these are the up years, right? There's some monsters. I think there's a 50% in here. Yeah, 52% in 1954. So if anyone's around in 1954 here that was investing, man, did you do well in the 50s. In 1955, you also made 33. In 1958, you made 43. So this is a good time to invest in the United States stock market, right? So these are the rates of return. These are the bad years. What I think is incredibly interesting is there are 4 years where the stock market did worse than 14.7% out of 80. It's not that much. None of these years was a result of the market was just too high and it came down, right? All of them were extreme external shocks, right? 2002 was like the follow-on from September 11th, right? And the war on terror. 2008, we all know about. The 70s were, both 73 and 74, right? Were oil embargo. 37 was part of the, I think that was right when the Nazis took power, and it looked like we might have another war. Europe was doing horrible. There was hyperinflation, right? So everything was down. So the 30s, 1930 did not look great for that reason. But again, that's an external shock. It was not just because the market was kind of high. So when the market is just kind of high, it can go down. But historically, I can't guess the future. Historically, they don't go down by huge numbers. So again, if you could sell away a little bit of your upside and take the premium that the person pays you for that, and then buy protection on the downside, if that protection could be about 10%, you are going to cover the vast majority of losses that typically happen in the stock market. Even with some of these huge losses in here, on average, the negative years are only 12.5. So if you could sell away some of your upside, so you're not stuck in bonds, right? Because bonds may not make that much in the next couple of years. So if you don't want to be stuck in bonds and you want to stick with stocks, adaptive risk is a pretty decent option. I think another decent option is something like this, where you're selling away a little bit of your upside. So you're getting the majority of the upside, way more than you'd make in a bond. And you're protecting, let's say, the first 10% of your downside. I think that can make a lot of sense. So you do that in an index also. So the fees are really low, a lot less than a typical mutual fund, even our ETF. And you get the growth up to the cap, and then you get the buffer, which is the downside protection of 10% or more. So again, if you don't have any of these in your portfolio, and you feel free to reach out to your AQuest advisor. If you're on this webinar and you are not yet a client, feel free to reach out. We can explain it to you. Just see if it makes sense for your portfolio or not. So what I would say is going to cash is the enemy. The market is super high. I would say most people are worried about it. And there are three strategies that are obvious and can work in a lot of portfolios, which are rebalancing. Everyone should be doing that anyway. Adaptive risk, and then that third strategy. And again, on the bottom, no strategy assures success or protects against loss. If you think we put that in, you're crazy. That is also our compliance department. Really, really doing a great job. All right, everyone. Well, thank you so much for your time. I really appreciate it. Again, if you have any questions, don't hesitate to reach out to your advisor, or whoever it is that you work with at AQuest. And I really appreciate your time. Everyone have a good one.